The Intelligent Investor by Benjamin Graham. Picture this: Sir Isaac Newton, the genius who figured out gravity and invented calculus, sitting in his study in 1720, utterly humiliated and refusing to let anyone speak two simple words in his presence. Those forbidden words? South Sea. What could possibly drive one of history's greatest minds to such despair? Let me tell you the story. That spring, Newton owned shares in the South Sea Company, the hottest stock in England. Everyone was going absolutely wild for it. Newton, being brilliant, looked around and thought, "This is getting ridiculous." He even said he could calculate the motions of the heavenly bodies, but not the madness of the people. So he did the smart thing. He sold his shares, doubling his money to a cool £7,000. Victory, right? Well, here's where it gets interesting. The stock kept climbing. And climbing. And his friends? They were making money hand over fist, bragging at every dinner party. Newton started feeling that gnawing sensation we all know too well, the fear of missing out. A few months later, our genius made a decidedly non-genius move. He jumped back in, buying shares at sky-high prices. Then the whole thing collapsed like a house of cards. Newton lost £20,000. That's over $3 million today. The loss devastated him so completely that for the rest of his life, he banned anyone from even mentioning the South Sea Company in his presence. So what happened? How does one of the smartest humans ever to walk the earth make such a catastrophic mistake with his money? Here's the thing: Newton didn't lack intelligence. He lacked emotional discipline. This brings us to a book that Warren Buffett calls, by far, the best book on investing ever written. The Intelligent Investor by Benjamin Graham. Now, Graham wasn't just incredibly successful. He was the greatest practical investment thinker of all time. He understood Newton's story on a personal level. His own family got wiped out in a stock market crash when he was young. He knew the gut-wrenching fear and humiliation of financial loss. So he spent his life creating a framework to protect people from their own worst enemy: themselves. This isn't one of those books promising secret formulas or quick riches. Actually, Graham promises the opposite. What you get instead is something far more valuable. You'll learn how to control the self-defeating behaviors that keep most people from reaching their financial goals. By the end of our time together, you'll understand 3 core secrets: the crucial difference between investing and gambling, how to handle the market's wild mood swings, and the one concept that can protect you from devastating losses. This isn't about being a genius. As Graham put it, this kind of intelligence is a trait more of the character than of the brain, and honestly, anyone can develop it. So let's dive in and discover what it really means to be an intelligent investor. To understand Benjamin Graham's philosophy, you need to grasp that there are 2 completely different games being played in the world of money. They look identical on the surface: stocks, money, profits. But deep down, they're as different as checkers and chess. Graham draws a crystal-clear line in the sand. On one side, investing. On the other, speculating. His definition of investing is deceptively simple. An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Let's unpack this, because it's the foundation for everything else. First, thorough analysis. You do your homework. You study a company's financial health, its track record, its management, its competitive position. You don't buy a stock because it has a cool name, or because some guy on television is excited about it. You're buying a piece of a real business, and you need to understand that business. Second, safety of principal. You protect yourself from serious loss. This doesn't mean you'll never lose money on a single investment. That's impossible. But you operate so you'll never get wiped out. Your first priority isn't making money. It's not losing the money you already have. Third, an adequate return. Notice he doesn't say extraordinary or maximum return. Adequate means it meets your goals. It's realistic. You're not trying to hit a home run every time. You're just trying to consistently get on base. Now, what about speculation? A speculator gambles that a stock's price will go up simply because they hope someone else will pay even more for it later. The speculator focuses on the stock price, that ticker flashing across the screen. The investor focuses on the value of the underlying business. Think of it this way. An investor buying a farm cares about the soil quality, rainfall, and the crops it'll produce year after year. That's the business. A speculator buying a farm doesn't care about crops. They're just hoping a developer shows up next year wanting to build a shopping mall and pays twice what they paid. They're betting on the price of the deed, not the value of the harvest. During the dot-com bubble of the late 90s, America became a nation of speculators. People were buying stocks in companies that had never earned a penny. eToys, for example, lost $2 for every dollar of toys it sold. Yet, at its peak, the market valued it at nearly $8 billion, more than the established, profitable Toys R Us. Why? Speculators didn't care about the business. They only cared that the price was going up. They bought because others were buying, caught in a frenzy, convinced prices would climb forever. Spoiler alert, they didn't. eToys went bankrupt, and its stock became worthless. Graham warns that confusing speculation with investing is the single most dangerous mistake you can make. If you want to speculate, fine, but treat it like Vegas. Set aside a small amount, your mad money, and be ready to lose every penny. But never, ever mix your speculative money with your investment money, and never fool yourself into thinking you're investing when you're really just gambling. Because people who invest make money for themselves. People who speculate make money for their brokers. Once you've committed to being an investor, you need to meet your new business partner. He's an odd fellow named Mr. Market. This is perhaps the most brilliant metaphor ever created for understanding the stock market. Graham asks you to imagine you own a share in a private business. One of your partners is Mr. Market. He's very obliging but extremely emotional. Every single day, Mr. Market shows up at your door. He tells you what he thinks your shares are worth, and offers to either buy your shares or sell you more of his at that price. Here's the thing about Mr. Market. He's manic-depressive. Some days, he arrives in wild euphoria. He's convinced the business is amazing, and its future is brilliant. Those days, he offers you a ridiculously high price for your shares. Other days, he's in the depths of despair. He's terrified, convinced the business is doomed. Those days, he practically begs you to take his shares for pennies on the dollar. Mr. Market has one other lovable feature. He doesn't mind being ignored. If his quotes don't interest you today, he'll be back tomorrow with a new one. The lesson is profound. You, the intelligent investor, aren't at his mercy. He's at yours. You're free to deal with him or ignore him as you see fit. Never sell just because he's panicking and offering low prices. Never rush to buy just because he's euphoric and quoting high prices. You're in control. You only do business with him when his mood serves your interests. His purpose is to serve you, not guide you. When he offers ridiculously low prices, that's your opportunity to buy wisely. When he offers ridiculously high prices, that's your chance to sell wisely. The rest of the time? Ignore him and pay attention to the actual businesses you own. This is the investor's basic advantage. A professional money manager, reporting performance every 3 months, often feels forced to follow Mr. Market's every move. If prices rise and he's not participating, clients pull their money. If prices fall, clients demand their money back, forcing him to sell at the worst possible time. But you have no such obligations. You have freedom to think for yourself. Graham writes, and these are some of the most important words in the book. The true investor is in that very position when he owns a listed common stock. He can take advantage of the daily market price or leave it alone, as dictated by his own judgment and inclination. He continues, the investor who lets himself be stampeded or unduly worried by unjustified market declines is perversely transforming his basic advantage into a basic disadvantage. In fact, you'd be better off if your stocks had no daily price at all, because then you'd be spared the mental anguish caused by other people's mistakes of judgment. But why do we find Mr. Market so seductive? Why is ignoring him so hard? Turns out our brains are wired to get us in trouble. We're pattern-seeking animals. When we see a stock rise 2 or 3 times in a row, our brain automatically expects it'll happen again. When it does, our brain releases dopamine, giving us a little pleasure rush. We become addicted to our own predictions. But when a stock drops, that financial loss triggers the same brain region that processes fear and anxiety, the fight or flight response. The pain of losing money is more than twice as intense as the pleasure of an equivalent gain. Making $1,000 feels good. Losing $1,000 feels absolutely terrible, more than twice as bad. This is why so many people do the exact opposite of what they should. They get euphoric with Mr. Market and buy high, chasing rising prices. They get terrified with him and sell low, panicking at the first sign of trouble. They let Mr. Market become their master. This brings us back to Sir Isaac Newton. Even he, with his supreme intellect, couldn't resist the crowd's pull. He couldn't stomach watching his friends get richer. He succumbed to the euphoria of his own internal Mr. Market. This is why Graham declares, in another timeless phrase, the investor's chief problem, and even his worst enemy, is likely to be himself. So how do you protect yourself from, yourself? How do you keep your emotions from destroying your financial future? Graham's answer is the central concept of his entire philosophy. If you remember nothing else from today, remember these 3 words: margin of safety. What is a margin of safety? It's the secret to sound investment, boiled down to its essence. It's about always leaving yourself room for error. Graham explains with a simple analogy. When an engineer builds a bridge, she calculates it must carry a maximum load of, say, 10,000 pounds. But she doesn't build it to hold just 10,000 pounds. She builds it to hold 30,000 pounds. That extra capacity is her margin of safety. It protects against unforeseen circumstances, bad luck, or human error. The intelligent investor does exactly the same thing. A margin of safety in investing means buying a stock for significantly less than its underlying value. You don't try to buy a business worth $83 for $80. You leave yourself an enormous cushion. You wait until you can buy it for $60 or $50 or even less. That difference, that discount between what you pay and the value you get, is your margin of safety. It protects you if your analysis is wrong. It protects you if the company's earnings decline. It protects you if the future turns out worse than expected. Let's look at a real-world example Graham uses. The Great Atlantic and Pacific Tea Company, better known as A&P. For decades, A&P was America's largest grocery chain. In 1938, during a recession and bear market, its stock price plunged to $36 a share. That price was extraordinary. At that level, the entire company was valued at about $126 million. But the balance sheet showed A&P had $85 million in cash alone. Its working capital, cash and inventory minus short-term debts, was $134 million. Think about that. The stock market valued the entire business, all its stores, its brand, its future earning power, for less than the cash it had in the bank. You could have bought the company, paid off all debts, and still had cash left over, with the entire business thrown in for free. That's a massive margin of safety. Why was it so cheap? Investors were panicking about new chain store taxes, declining profits, and the depressed market. They were letting Mr. Market's terrible mood dictate their judgment. An intelligent investor, armed with the margin of safety principle, would have seen this not as a risk, but as a once-in-a-lifetime opportunity. What happened next? The following year, A&P's stock price more than tripled. The margin of safety doesn't just make an accurate estimate of the future unnecessary, it makes it irrelevant. With a large enough margin, you don't need to be right about the future. You just need to avoid being catastrophically wrong. The cushion protects you. This leads to a crucial insight. Risk isn't in the stock. It's in the price you pay for it. A great company can be a terrible investment if you pay too much. A mediocre company can be a great investment if you pay little enough. In 1961, A&P was still a great company. But investors, now wildly optimistic, pushed its price to 30 times annual earnings. At that price, there was no margin of safety. Investors were paying for decades of perfect growth in advance. When that growth didn't materialize, the stock crashed, losing more than half its value. Same business. In one instance, a spectacular bargain. In another, a reckless gamble. The only thing that changed was the price, and with it, the margin of safety. So how do you actually put these principles into practice? How do you build a portfolio as an intelligent investor? Graham understood not everyone has the time, skill, or temperament to be a full-time stock picker. So he divided intelligent investors into two camps, the defensive investor and the enterprising investor. It's crucial to understand that defensive doesn't mean timid, and enterprising doesn't mean risky. The difference isn't about risks you take, but about work you're willing to do. Let's start with the defensive investor. The defensive investor's goal is, quote, safety plus freedom from bother. This is for someone who doesn't have much time for investments and wants to keep things simple and automated. The first rule is creating a balanced portfolio. Graham recommended a simple 50-50 split between high-grade bonds and diversified common stocks. He insisted you should never have less than 25% in stocks, nor more than 75%. This simple rule is a powerful tool for emotional discipline. When the stock market is soaring and everyone's getting greedy, your rule forces you to sell some stocks to get back to your 50-50 target. It forces you to sell high. When the market's crashing and everyone's panicking, your rule forces you to use bond money to buy more stocks. It forces you to buy low. It's a beautifully simple mechanical way to master your emotions and act opposite to the crowd. The second tool is diversification. You should own a wide variety of stocks, perhaps 10 to 30. But Graham recognized even this was too much work for most people. His solution, revolutionary for his time, is what we now call an index fund. A total stock market index fund is the ultimate tool for defensive investors. It owns a tiny piece of almost every publicly traded company. Maximum diversification at rock-bottom cost. You don't pick the right stocks or worry about which industry will be hot next. You simply own them all. By combining simple asset allocation with an index fund and adding a third tool, dollar-cost averaging, the defensive investor can put their entire financial life on autopilot. Dollar-cost averaging just means investing the same amount every single month. Like clockwork, when the market's high, your fixed amount buys fewer shares. When the market's low, that same amount buys more shares. It's another way to force yourself to buy more when prices are low and less when they're high. This three-part strategy, balanced portfolio, index fund, and dollar-cost averaging, is perfect for defensive investors. It requires almost no effort, very little time, and builds an unbreakable wall between your money and your worst emotional impulses. Now, what about the other path? The enterprising investor. The enterprising investor is willing to devote time and energy to researching individual stocks, hoping for better-than-average returns. This path isn't for everyone. It's intellectually demanding and requires a business-like approach. Graham is very clear. You can't be half a businessman. You either do the work or stick to the defensive path. There's no middle ground. For those willing to do the work, Graham suggests 3 hunting grounds. First, buying large, relatively unpopular companies. The market often gets overly pessimistic about big, stable companies going through temporary trouble. Their stock prices can fall to unreasonably low levels, creating a margin of safety for patient investors who can see beyond current gloom. These are giants that have been knocked down but are far from knocked out. Second, buying, quote, bargain issues. This is Graham's classic strategy of searching for stocks trading for less than their net working capital. These are the A and P situations. Companies selling for less than their cash and easily sellable assets. Finding these is rare, but when you do, your margin of safety is immense. Third, special situations or workouts. These often involve companies going through mergers, liquidations, or reorganizations. They're complex and require high expertise. For most individuals, even enterprising ones, this field is best left to professionals. The key to all these enterprising strategies is they're based on value, not popularity. They require you to be a contrarian, think independently, and buy what others are pessimistically selling. Does it work? Can this approach actually lead to superior results? The most powerful proof comes from Graham's most famous student, Warren Buffett. In a famous speech, Buffett talked about the super investors of Graham and Doddsville. He presented track records of several investors who learned directly from Benjamin Graham. These investors operated independently. They bought different stocks at different times. Some owned hundreds of stocks, others owned only a handful, but they all had one thing in common. They followed Graham's principles of buying businesses with a margin of safety. Over many decades, every single one of them absolutely crushed market averages. The odds of this happening by pure chance were, as Buffett demonstrated, infinitesimally small. It's like a national coin-flipping contest, where, after 20 days, you discover 40 of the 215 winners all came from the same tiny Nebraska town. You'd know there was something special about that town. Graham and Doddsville was that special town. Its intellectual water was the margin of safety principle. Those who drank from it prospered. The enterprising investor's path is difficult, but for those with the right temperament and willingness to work, the rewards can be extraordinary. As we wrap up our journey through the intelligent investor, it's worth reflecting on just how timeless Benjamin Graham's wisdom truly is. The names of hot stocks change, from railroads in his day to dot-coms in ours, but underlying human behavior never does. The siren songs of speculation, greed, and fear are constants in the financial world. That's why this book remains so vital. It's not really about stocks. It's about behavior. It's about how to be rational in a world that's often anything but. Graham's central message is that investing success doesn't come from being smarter than everyone else. It comes from being more disciplined than everyone else. It comes from knowing the difference between price and value. It comes from understanding the market is there to serve you, not instruct you. And it comes from realizing the biggest risk isn't in the market, it's in yourself. If you're just starting your financial journey, what are the most important takeaways? First, start with knowledge, not with money. Before you invest a single dollar, invest your time. Read this book. Practice tracking a few companies you're interested in, but do it on paper. Get a feel for the market's rhythm and, more importantly, your own emotions' rhythm. See how you feel when a stock you own goes down. Does it make you want to sell, or does it make you wish you could buy more at a cheaper price? Answering that question honestly will tell you a lot about what kind of investor you are. Second, be brutally honest with yourself about whether you want to be a defensive or enterprising investor. There's no shame in choosing the defensive path. In fact, for the vast majority of people, it's the wiser choice. Building a simple, automated portfolio with low-cost index funds is a powerful and proven path to long-term wealth. Don't let anyone tell you it's too simple or unsophisticated. Simplicity is often the ultimate sophistication. Third, embrace the margin of safety. This is more than just an investing technique. It's a life philosophy. It's about building a cushion into everything you do. It's about not driving too fast, not living too close to the financial edge, and not betting your entire future on a single, uncertain outcome. It's about humility, recognizing the future is unknowable and you must be prepared for the unexpected. We've covered a lot of ground today, but this summary is just the beginning. The real power of the intelligent investor isn't in just hearing about its ideas, but in living with them. It's a book to be read, then reread, throughout your life. The stories and principles will hit you differently at different stages, and each reading will reveal new layers of wisdom. If anything we've talked about has struck a chord, I truly encourage you to pick up a copy. Reading it isn't just about learning. It's an experience that can genuinely shape how you think about money, risk, and yourself. You'll find a link to the book in the description below. If you found this summary valuable, please take a moment to like this video and subscribe to our channel. We have so many more journeys to take together into the world's most life-changing books. Let's keep growing and learning together.